So I would avoid all metals at this point of time.
All right. Dipan, just stay on. We'll come to you in just a bit. We have a big voice joining us now. Keki Mistry joins in to give us a view on how things are shaping up post the interest rate hike, as well as the way forward for the company. Mr. Mistry, good morning, and thanks a lot for joining in. Can you tell us first on the interest rate hikes itself, how has it changed the dynamics in the real estate sector? And, what is the way forward? Do you think we are headed on, do you expect to see more rate hikes from here on? And what would the impact be?
It's a difficult situation for RBI to handle. My sense is that Fed may continue rate hikes for some time. However, I do personally believe, and this is after talking to a number of investors, that it is a possibility that somewhere in the second half of next year, US could actually lead to a situation where Fed may actually look to reduce rates and not increase rates any further. So it's a short-lived problem. We can partly overcome that problem by maybe getting India included in the bond index. If there is, as you know, a JP Morgan bond index and Bloomberg bond index, which is where the index constituents will be decided soon. And if we can get included in the bond index, then that automatically brings in something like $30 to $35 billion into India. If we get $35 billion in India over the next 12 months, that obviates the necessity to increase interest rates every time Fed does it. So that's my personal view. But having said that, till such time as Fed remains aggressive, we might see some more rate hikes in India also. Though I don't believe that the rate hikes going forward will be that many or that sharp incrementally.
Mr. Mistry, coming to the real estate market itself, what do you think and how do you think the sector will behave should rates continue to move higher? What is the absorption capacity in a worst-case scenario? For example, if rates move up by another 100 basis points, what do you think will be the impact on growth and margins?
On individual loans, our loans get repriced every quarter from the day you took the loan, whereas on the liability side, the repricing might be a little faster. So this works both ways when interest rates go up or interest rates go down, but that is a very temporary impact which is typically there for 1 or 1.5 months and not more than that. But otherwise, margins will remain stable. Now, when you talk of growth, what we must understand that as a housing loan, unlike a consumer durable loan, or unlike a auto loan, or unlike a bike loan or something like that, is taken for a much longer time frame. The average term of a housing loan from door to door stretches from 12 to 13 years at the time the loan was taken. Now, over that period of 12 or 13 years, interest rates in India will go up and interest rates will come down. That is a normal automatic phenomenon that we will see. So it really does not make so much difference where interest rates are at the time when you've taken the loan, because if at that point of time rates are high, then at some point of time rates will come down and vice versa.
So some news reports suggest that home buyers are becoming a bit cautious now. Are you noticing any such trend? And at what level of interest rates does it start impacting growth or asset quality, you think?
Our experience over this last 40 years of business, and particularly so the last 20 plus years when floating rates became popular, is that there is no impact, no long-term impact on asset quality. Just to give you a sense of asset quality at HDFC on individual loans, individual housing loans, from the time we started giving loans in 1977 till today, over a period of 45 years or so, our total loan losses, money we've not been able to recover, has been only 0.06% of the total loans we've disbursed cumulatively over a period of 45 years. So a housing loan is very different from any other product. The family stays in the house. It's the single biggest possession for a family. The amount we finance of a property typically is about 68, 69%. So there is a huge amount of equity that the individual has in the property. And more importantly, a housing loan is an amortizing loan. So the moment you get the loan, from the next month itself, you start paying an installment, and that installment has got a principal component. So with every passing month, the outstanding amount of the property, outstanding amount of the loan keeps declining. And therefore, for a moment, if you assume that property prices were flat and not rising as they probably could in line with inflation, if you assume property prices were flat, you would see the loan-to-value ratio keep declining every year, which means the individual's equity in the property keeps increasing. So therefore, usually you find that there is no impact on default or on loan losses.
Mr. Mistry, are you seeing a pickup in wholesale lending?
See, on the wholesale side, there are three categories of loans we have. One is construction finance, the second is lease rental discounting loans, and the third is corporate loans. Now, construction finance, which at one time used to be about 14% of our book, is now come down to about 9% of our book. Now, the primary reason is that the period from 2017 to 2020, or I would say 17 to 20, did see some amount of slowdown in demand for under construction properties in metros, in cities like Mumbai, Delhi, Bangalore, and so on and so forth. And because there was a slowdown in demand for under construction properties, there were not that many new projects that were launched. Project launches started again from 2021. So from 2021, again, there has been a sharp pickup in the number of new projects being launched. But between that 2017 to 20 period, launch of new projects had slowed down. Now, in a construction finance loan, unlike a lease rental discounting loan, the disbursement for that loan is made gradually over a period of time. So usually the developer puts in his own equity first, and then the lending institution starts disbursing money as the developer starts constructing. So disbursements tend to be more back-ended rather than front-ended. Whereas in a LRD loan, the disbursement is made upfront. So therefore, you will see a growth in the loan book, in the non-individual loan book over a period of time. That's the guidance we've given to investors now for the last couple of quarters. There has been a sharp pickup in the number of new projects being launched. And therefore, hopefully over a period of time, you will start seeing the non-individual book pick up.
Okay. Mr. Mistry, you started funding self-employed category of, loans for housing. Are you witnessing any competition with dominant players in those markets? How is the situation on the ground now?
HDFC's individual home loan book grew by 19%, which would include for employed customers and self-employed customers. The housing loan growth in the banking system at the same time was about 16.2%, if memory serves me right. So we grew at a rate which is nearly 3% faster than what the banks grew at. And you will see something similar happening in March of 2022 and something similar happening the last 3 or 4 quarters if you were to look at it. So consistently, we've been growing at a pace which is faster than the banking system is growing. There is competition in the market. Of course, there is competition. There always has been competition, but it's not that competition is, competition is very realistic. Competition is not mispricing anything. And at the end of the day, there is such a huge market to cater to. No one needs to do anything which is irrational. You must remember that the penetration of housing loans in India is one of the lowest in the world, at about 11% of GDP. And if you look at that number in Western countries, it's all over 50%, 60%, 70%, and so on and so forth. But even if we were to look at many emerging markets, the mortgage to GDP ratio would be upwards of 20%. We are still 11%. So it's a very underpenetrated market. And my sense is that no one in this market needs to do anything irrational because there is growth opportunity for everyone.
Mr. Mistry, in the current liquidity environment, are you changing, any thoughts with respect to merger implementation? Anything on that?
If you see the last 6 months or so data, the growth of deposits in the banking system has been relatively low compared to the growth of loans in the banking system. But having said that, if you compare the last 3-4 fortnightly reports, you would see that the percentage is inching up. The total level of deposits are inching up. And what will happen now is as interest rates have gone up quite a lot in the last couple of months, so the benefit of that higher interest rates will ultimately move to the retail depositor. So you will see more people putting or willing to put money in bank deposits going forward compared to what we were seeing in the past. What we saw last year was that deposit rates in India were very low because interest rates were so low. And therefore, for many consumers, many individuals, they preferred to put their investments in some other instrument rather than put money in bank deposits. But with rates going up, that will change.